we go. Hello, 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 everyone. We are so excited to have a wonderful speaker who's just like the most giving person you have ever heard. And as you know, we're investment advisors. And if you ever want to invest in commercial real estate, give us a call. If you've got something you want looked at, we'd be happy to take a look at it for you also. But I always like to find a quote that works for the person that is presenting. And Ron is such a generous gentleman who helps so many people.
Just remember, Peggy, flattery will get you everywhere. Just keep
Okay,
talking.
good. I'll keep that in mind. It is a great mistake for men to give up paying compliments, for when they give up saying what is charming, they give up thinking about what is charming. And that is Oscar Wilde. Who else?
Yeah.
So we are so very excited today to have Ronald Heyman here. Where'd your stuff go that I have all?
Haycock.
Haycock.
That's
Ron Haycock.
Yeah.
Is an impressive individual with wealth of experience in business, cross-cultural understanding, and community service. That's why I did that quote. He's been married since 1979 and the father of, are you ready? 9 children. Good for you, Ron. Ron served in the Marine Corps from 1968 to 1972 as a public relations NCO in Japan, where he fell in love with the culture and the language. After his mission, Ron pursued his education, earning a bachelor in business administration in 1985 and studied forensics auditing at the American College of Forensics Examiners Institute. Those institutes.
Long name.
Long name, yes. Tongue twister for me. He has purchased and sold many businesses and real estate properties, showing the entrepreneurial spirit. He's also been involved in helping over 700 small businesses get started, written 4 books, and presented numerous seminars on business organizations. Ron's dedication to family, community service, and entrepreneurship makes him an exceptional individual. His cross-cultural understanding and expertise in business makes him a valuable resource for many of us, those seeking active success. To achieve, well, both active and achieve success. His remarkable accomplishments and unwavering dedication to helping others make him an inspiration and a role model for entrepreneurs everywhere and anywhere. Because you know what, Ron? They're all around the world. So we are so thrilled to have you here. And we know you have a little bit longer presentation, but feel free to let me cut you off if it gets too long.
Glad to do that. And they're okay. Questions.
So here we are. Take it away. Hi, Mary. Glad to see you. Jay, Ethan, Debbie. You're up, Ron. You want to share your screen and we could get started.
Be glad to do that. Just for your information, Peggy, the bio you were reading is a little older. Since that bio is written, I've helped a little bit more businesses. Altogether, I've helped over 4,000 small businesses.
Oh my God.
Right?
Oh my God.
Of all levels. Right? And I've helped even another 1,000 or better reorganize after they were organized.
Good. So that's what we want to know. How do you help them? What makes them successful? So take it away.
Let's talk about it from the real estate side. Okay.
Okay.
So
that's a business too.
That's exactly correct. And my biggest concern about real estate investors is they say, I like real estate because of passive income.
Well, that's as you know.
If you've got the little ability to raise your hand, all of those who want passive income, would you raise your hand?
I'll take it any way I could get it.
And I'm going to tell you right now that you don't want passive income.
Oh.
What you want is active income. Passive income has limitations.
Yes, it does. Okay?
So let's see if I can get this to work. How come it's not working here?
Yep. Well, there's my first question.
There we go. Where's the first question? How do I get it to work?
No, if you're active, that means you have to learn everything there is to know about real estate so you don't make a mistake. Whereas if you're passive, you could be doing what you love in your job and have your money working for you. Even though there's limitations, you still get tax advantages.
Actually, the passive income has limited tax advantages.
Yes, it does,
So-
and you're limited.
Right. And so we'll show you how to maximize those tax advantages. Right.
Yep. Yeah, if you could show us how you could be get active by being passive, that'd be fantastic.
And we want you to be active and not passive. But as you can see,
know
those are
you
my
do, but-
certifications.
All we work with are passive investors, so
Well, actually, we want them to become active. We're going to show you how to make it active. Okay. That's the whole idea behind all of this stuff here. Now let's see if I can get this to work here. If I'm going to, there we go. So I am a forensic auditor, but my auditing experience and auditing accreditation is in real estate auditing, in mortgages, because I owned a business. This is my family right here. I have 9 children and 20 grandchildren. My wife and I have been married for 45 years. And as you can see, I was in the Marine Corps. This is the governor of our state, and I presented him with a message of thank you from one of the groups that we belong to. Okay, and this is my wife over there. Now, we want to talk about a real estate story that's going to help you learn, hopefully, right? The idea is you don't want to own anything. I don't want any of you guys to own real estate. You don't make money by owning an asset. You make money by control, right? So you have to control it, but not own it. And I've been in real estate. I've bought, when the market crashed, I've probably, one of the things that allows me to have any kind of authority in this is I've probably lost more money than most people have ever made in their lifetime. When the market crashed in 2008, I owned another accounting firm. I also owned a mortgage, contract mortgage processing company. I owned an insurance agency. I owned a real estate inspection company, and we did a lot of joint venture agreements with property owners. And when the market crashed, it began in 2006. Between the beginning of 2006 and the end of 2007, I had 160 banks that I was dealing with went out of business. And between the middle of 2006 and the end of beginning of 2008, in the middle of 2008, I had 93 real estate properties going to foreclosure because renters were walking away and leaving us behind and not paying their rents. So I called all of my clients in and I said, if you'll hold me harmless, I will walk away from my ownership in your company and my investment. And I did, walked away from over $1 million. And then I had to short sell my dream home, 3 acres, 6,600 square feet, 9 bedrooms, 7 bathrooms. You know, that I need something that big for my family. I had to short sell that and lost another $500,000. Okay, so what we want you to do is to prepare for your estate. We want you to prepare for your heirs, and we want you to take advantage of every IRS rule that you can. You can do whatever you want to if you know the rules. You've got to stay within the lanes. You've got to drive correctly. So anybody have any idea, if you want to answer now, what is it in business that keeps you safe? What is it that keeps you from being sued? Anybody have any idea?
Well,
Nobody on my team answer this, please.
well, having integrity makes a big difference, and giving updates and showing what your numbers are.
Well, that's a good point. That is exactly correct. But what keeps you safe in this is acting like a business, separating yourself from the business and following the business formalities, acting like a business and not like an individual. That's why passive income, when you do passive income, and we'll go through this a little bit in a minute, passive income makes you an investor, right? And an employee, not an owner. And we want to change that. We'll talk about that in a minute, okay? So the key to being successful in anything is your organization, okay? And that's what we want to do. I got to get these pictures out of the way here, if I can. There we go. Here are the different types of businesses. You can have a C corporation and an S corp. Most people don't know the difference. And I'll show you in a minute that there are 23 tax disadvantages for an S corporation and only one advantage. You need to know how to use these companies together, when to use them, why to use them, how to use them for your benefit and for your protection, right? But one of the things that you need to do for sure is to have a trust. You do not put the property into the trust ever, because either you lose control or you have no protection. You use the trust to control your ownership in the businesses. So you want your trust to be an owner of whatever business you put together, right? You don't need all of them, so you have to decide, do you need them all or do you just need one? Remember the KISS principle. Who knows what the KISS principle is?
Keep it simple, silly.
That's a nice way of putting it. The real way of putting it is keep it simple, stupid. But my wife won't let me tell anybody they're stupid. So I always say, keep it stupidly simple. Dumb it down. Make it easy to get into, easy to manage. And if somebody comes after you, easy to walk away without losing your shirt. Okay? What we're doing nationally, and right now we have 15 offices nationally, is we're building a consortium of licensed and credentialed professionals that provide for the small business owner everything that they need to have under one roof, and do it at a price that the wealthy pay mega bucks for. But we're going to do it at a price the small business owner can afford. We can give you anything. And every one of these professionals are brought inside. I stand there at the door inviting them to come into your organization and see it from the same direction. Okay? Right now, this is just some of our individuals. Now, you set up your business to stay out of trouble. Do not use do-it-yourself online things. I can guarantee you that 90% of the people that I deal with, and some, I think maybe even more, a higher percentage, I have to go in and fix. We have to change it because you don't have the experience. You're good at what you do. You're experienced. You're trained. Our training is in organization and structure. Fact is, most clients, I had an accountant, a CPA that said, and I had my office was with his office at one time. He said, Ron, I want you to go to this mortgage company and get things reorganized and get things set up. And I said, Doug, you have as much training as I do. Why can't you do that? He said, my license excludes me from doing this. It hinders my work. You go in, you do it, you put it together. I'll come in and audit your work, and then we have an audited report that we can give. And that's what we try to do for all of our clients. Let's make sure you do it properly from the beginning. Most small business owners take their business and make it look like this on the left-hand side. Call themselves an LLC, but a single member LLC doesn't give you any protection. You can't separate yourself. Right. An S corporation is the same way. All you are is an alter ego. What we want to do is to put you so that you have more than just a business. The roof is the name of your business, but there's no structure, no foundation, no support system. Even though it may look ugly, we want it to be solid. Okay? I'm gonna tell you a little story here, and you make sure I stay on time, Peggy. Okay? See this guy here putting the siding on this nice little shed here? His brother was out in the truck taking the siding out and bringing it over, and he saw his brother reach into his nail pouch and pull out a handful of nails, pick some of them up out of his hand and throw them away and put the siding up. Then he saw them do it again. Take out a handful of nails, pick some out of the hand, threw them away and put the siding up. He came over and said, brother, what are you doing? And he said, well, when I take the nails out of my pouch, Some of them are upside down. I just throw those away. And he said, are you stupid? Don't you realize that those nails are for the other side of the building? Make sure you know where to put the nails in your siding. Okay? Before you build your mansion, start with your log cabin. Okay? When you have in your business, you need at least 4 people to help. You need an accountant, you need a good attorney, you need an estate planner, and you are the managers, but you need some coaching once in a while. I haven't found a business owner, I don't care how long you've been in business, that doesn't need to learn something somewhere. The problem is you see them from different angles. So you go to an accountant and he sees one thing, you go to an attorney, he sees something else, and they give conflicting advice. Who do you believe? We want to bring them inside, just like we showed you before. You need a strategic advisor. And as I showed you in our last thing, all of these people that here, one of them is specifically, we call him a CSA, Corporate Strategic Advisor. He's there to make sure that you follow the IRS rules. You stay in the path. You do what's necessary to achieve your goals, but not get yourself in trouble. Okay? Now, let's talk about why you buy real estate. It's a good investment. Question is, can you survive an economic downturn? In 1980, I had an escrow company. We did really well from 1979 until 1982. And then all of a sudden, because of Jimmy Carter's economic policies, we had banks failing, we had all sorts of things failing. And then all of a sudden, nobody was being able to get any business whatsoever. So my clients hired me to go out and find money. While I was gone to try to find them money, our corporate treasurer embezzled $150,000 of trust funds. And the IRS doesn't say, you're out of, you're good, we'll figure it out, and we'll help you stay in business. Now, they just put me right out of business. They didn't have any choice. And so did the state. My attorney at the time was Michael Nider. And so Michael Nider actually showed me how to get started on this path, how to own nothing, but control everything. And the way you do that is by layering. Now, I don't think in California, Peggy, you do a lot of skiing, but some of the other ones may be in other countries or in other states. I do skiing. I used to be the staff accountant for one of the major park city ski resorts here in Utah. While I'm on the mountains, all the people see is my brand, my jacket, right? They don't see anything else. They see no skin. They don't know me. They may know my voice because I may talk to them while I'm on the slopes, but they don't know me. I go down and get a sandwich at the coffee shop, take my jacket off. They never know it's the same person. Now, the question is, what happens if I'm a clumsy skier, which I am, and I bump into a tree and this nice branch rips a hole in my jacket? All of a sudden, the cold's starting to penetrate and affect everything underneath me. What do? What I do is go to the bottom of the hill as fast as I can get there, throw that jacket away, put a new one on in its place. It doesn't affect the rest of my underneath layers, and I protect me and my assets. Right? I could use another word, but I won't because this is public. Right? But I protect myself. I just change the brand. I don't lose anything. You do the same thing in business. You put yourself in a position where you lose nothing if something goes wrong. Right? So question number 2, do you do it to leave something to your family? Can you do it with or without tax? How about probate? Do you realize that if you have a trust as one of the owners of your business, and it's the right kind of trust, owns no assets, but it helps with you own the business. If something happens to you, that trust can continue operating your business without probate. What's the definition of asset? Anybody know? Most people think that it's something that's tangible. From a financial point of view, An asset is something that makes you money. If you don't make money, it's not an asset. So let me ask you a question. How about your house? Is it making you money?
Mm-mm.
It's just a liability. How about your cars? Are they making you money? How about your furniture? Does it make you money? Why not take all of those things that you own and turn them into assets that make you money? And you get to keep control and stay in those places and keep the cars and use them. Never keep a mileage log again. Never. And have your business deduct all of the expenses of your home as a tax deduction. Okay? How about number 3? Passive income. Instead of passive income, how about reoccurring income? How about taking your real estate investment and making it a business so that the business income is not passive? It's not just something that you're incurring. It's something that you are involved with because your business owns the real estate. Your business manages the real estate. You own the business, therefore you manage the real estate. And because of that, you can have a property manager if you need to, but there's a certain way to do it. And I can talk to you about that later on, okay? But we want to turn the money into ordinary income, not passive income, okay? What's passive income? It's income that's generated that doesn't involve significant labor, energy, time, or to earn the money. We want to change that, right? And what's the tax rate on passive? In most cases, properties we class as passive income, and a non-passive income takes care of all of these things. Active participants earn active income, ordinary income. Passive income is non-earned. Therefore, your tax deductions are limited, and your ability to write off deductions and limit the tax liability is limited. Okay? We want you to avoid passive active losses. Right? Here it says here that you have to have 750 hours of service during your tax year. That's if you are a real estate professional. But how about ordinary people? Let's turn ordinary individuals, ordinary investors, ordinary property owners into business owners so that you're not doing just 750 hours of service for that year. You're actively involved in owning and running that business every day of your life. Unless you go to church on Sunday. I don't work on Sundays, so I don't do it on Sundays. Okay? Now, material participation test. You have to have 500 hours. You have to be all of the people in there have to be active, right? So you have to have all of those participations. Everything has to be done. All of this you have to work on. Okay, now let's see, what am I doing here? I'm not going forward. There we go. Now, here's the problem with having a property manager. At the end of the year, if you hire a property manager, because he collects the money, he deals with the tenants, he pays any vendors on the outside that do services for the company, and then at the end of the year, or he sends you a 1099. He just sends you a 1099 for whatever he hasn't spent. He's treating your real estate property as his property. We have contracts that we deal with property managers which turn it the other way. Have the property manager do it, keep the same amount, but he works under your direction. You pay the vendors, he collects the money, he puts a little aside, sends you all of that money, and then you pay the bills. You become the manager, he becomes a vendor to you, he becomes a contractor to you. You send him a 1099 at the end of the year. Okay? We want you to change passive rental income to recurring income. LLC is a partnership for tax purposes. S corporations, and is a business purpose for anything other than owning real estate. You don't want to own real estate if you're an S corp. Okay. The LLC contracts with the property manager. You send your LLC, and they send you your LLC a W-9 or 1099, right? So what we want you to do is all of this stuff. You get a W-9 from them, not vice versa. You sign the contracts. You get the money from your property manager, right? He'll put together a little bit of a slush fund, but you pay the invoices. You pay the bills. So if you don't want to spend that kind of time doing it, then you are going to limit yourself, okay? And I think that you can do it just as well if you're owning a business and run a business. Just get it done. Get your bookkeeper to do it for you, right? We want to send your property manager a 1099.
Well, we always do.
Right? You don't have to work the 750 hours. The income is no longer passive, right? Your lifestyle is not affected, and time constraints are not overbearing. You don't have to spend a lot of time. Your property manager is a contractor that takes a lot of that load off. You're still in control. Now, fourth reason for buying it, own a business. Anybody know what a hobby business is?
Yeah, it's one where you don't make money.
Not necessarily. You can make money in a hobby business, right? It's one where you are not organized. You don't have a structure, right? You can make money, but you're doing it as a secondary business, which is fine. And that's where a lot of real estate investors are. They do it as a secondary income. We want to get you from being a hobby business and turn your business into an active material business. Okay? Real business versus a hobby business has a profit motive. A hobby business doesn't even understand what a profit motive is. They hold meetings, they keep minutes, they have an operating agreement, or they have bylaws, depending on how they're organized. Hobby businesses don't do any of that. Their money is separate from their personal income. And hobby businesses keep everything in their own personal bank account. They operate as the entity dictates, and the individual operates strictly as a sole proprietor. They protect against assets and protect assets against lawsuits. And why do they do that? Why does it protect against lawsuits? Because they act as a business. They have separated you from the business. The IRS calls this related party rules. IRS allows deductions for that. If you're related to your business, you cannot have a conflict of interest, or you have no advantages, okay? So John Rockefeller, and by the way, I copyrighted this. I wrote a book on it called Own Nothing, Control Everything, and I have a small video called The Once Cash Flow Strategy. Once, O-N-C-E. And we copyrighted that. And the idea is you don't make money by owning an asset. You make money by controlling an asset, right?
Mm-hmm.
The protection comes from being organized correctly, just like a trailer. Anybody goes in a trailer, there's a storm comes, they're protected from the storm. They can do whatever they want to in the trailer. Everybody gets the same thing. Everything that's done in the trailer stays in the trailer. You don't have that same thing for a pup tent. If you're outside that trailer and the storm hits, you're going to get soaked, right? Everything for the business goes inside the business. Use the formalities. Businesses cannot treat owners outside the business any different than it treats anybody else. That's called related party rules. Maximum protection, all transactions must be arm's length. In other words, they cannot treat you any differently than they would treat anybody else. And that business cannot treat each other any differently. If you've got more than one business, the only way that you can move money, the only way that you can work together is by contract, by legal documentation.
Mm-hmm.
Okay? So the last one, again, you want to become wealthy, but have you considered taxes? I've read this book and I've gone to several of her seminars. If you want to be a millionaire, you act like one, right? And most of them have multiple corporations and trusts as well as charities. corporations include LLCs, like the organization that I told you. We want to have them to maximize tax strategies, create liability protection, ensure asset protection, and keep the wealth so that it goes through your family and you earn the wealth not from just one source, but from multiple sources. Okay, so you've got all of these organizations again, right? There's your organizations, there's your structure, but you have to bring them inside. You've got to let them see your structure so that the attorney and the accountant doesn't conflict with each other, and the estate planner is involved and understands what you're trying to achieve. And you have an advisor to help you and work with you. Layering is the protection, not just one structure. Okay? You need a group of structures that work together to maximize tax deductions and opportunities, not with just one structure. Okay? These are the ones you use. Know when to use them, how to use them, and what to put together. Almost with everybody, and Daniel can tell you the same thing, and Patricia and anybody else on our staff can tell you that we do everything we can to get people out of S corporations. There's very few, for small businesses especially, benefits for an S corporation. Okay? Here's the formalities that you have to have shareholders, you have board of directors. You know, those are for a corporation. Corporations and LLCs can do exactly the same thing. But corporations, there are some things that corporations can do, LLCs cannot. Some things that LLCs can do, the corporations cannot. Therefore, you work them together, right? Subchapter S corporations, I've got all of this here. There are 23 tax disadvantages and only one advantage for an S corp, and that one advantage is there's no self-employment income. Here are the different types of LLCs. Single member LLCs cannot separate themselves from the owner. And most S corporations are single member LLCs being taxed as a corporation. The individual owner is not separated. The IRS considers that an alter ego. Multi-member, we always tax them as a partnership. And the multi-member should be, from our opinion, husband, wife, and revocable trust, not an irrevocable trust. 3 partners, 3 of them working as an LLC, where the partners are separate from the LLC. Okay? Then there's nonprofits LLCs if you want to, and professional LLCs. Those have all got to be operated the same. A series LLC now offers one advantage. You can have several pieces of property owned by an LLC, but you want to separate them so one LLC owns one property. And if you do that, you have one of those LLCs that's a master LLC, and the others are series. When you do your taxes, you only have one tax return. But the individuality of the LLC protects you from lawsuits.
So what's the advantage of having a C corp?
Well, the C corp can offer protection for assets that you don't. What we want to do is to have the C corporation be a provider for tax purposes. For instance, right?
It has
you
to
have
pay
a car.
taxes.
You have a car.
Yeah.
Right? So you have an LLC that owns your house, owns your cars, owns your furniture. You rent all of those to the corporation. So now the corporation doesn't own them, but they're renting an office in your home, they're renting your cars, and you and your family are the officers of the corporation. Therefore, you drive a company rented car. And the corporation pays all of the gas, all the tires, all the oil changes, everything for the operation of that car. But now the LLC gets to own the car. It's no longer a company-owned car, so mileage is irrelevant, and you get to deduct the depreciation 100% irrelevant of mileage, and write off the use costs as well. So you get double tax benefits.
Well, that works at an S corp also.
No, it doesn't. You can do the renting on there, But there are things that an S corporation cannot do. For instance, you have health insurance, Peggy?
Yes.
And if you have health insurance and it's through either a corporation or an LLC, a C corporation or an LLC, the C corporation can pay for the premiums and write them off.
Mm-hmm.
S corporations cannot.
Mm-hmm.
S corporations, if they pay for you as an owner, you have to show that premium payment as guaranteed income. That's not a tax deduction, is it, for you? Okay, but a C corporation doesn't. Then the C corporation, the IRS allows you to do what they call health reimbursement arrangement. You have co-pays for the insurance, you have co-pays for doctor visits, medical costs. The corporation, you turn those receipts into the corporation, and the corporation can reimburse you 100% for those costs, and you don't have to write off. I mean, you don't have to declare any of that as income, and the corporation can deduct 100% of that as a tax deduction. S corporations cannot do that. Okay.
Okay.
Number three,
That's
if you
on
got,
health.
go ahead, sorry.
No, I said, well, that's on health, but as far as the car goes,
The car is the same thing. The car
they
could
write
do that.
everything off. I don't know. We write everything off.
Okay, but the problem of it is in an S corporation, you're not writing everything off. You're writing off the expenses, but an S corporation limits you to how much depreciation you get to handle, to write off. Number four, I don't know whether you've got children that are young enough now, but for those who do, you can have your children work for your wholly owned family LLC that is owned by your spouse and your trust, and you can write off $12,500 for each child. S corporations you cannot do that with. C corporations you cannot do that with. And the distribution for an S corporation at the end of the year, yes, the distribution is passive income. They're treating you like an investor. That's a capital gain, and you have to pay a capital gains tax on it. But if you have an LLC and a corporation working together, because of the contracts, you can have each of those write off all of your personal household expenses, everything except groceries and clothing and haircuts and stuff like that. You can have them together write off all those expenses, which you cannot do with an S corp.
Okay. Patricia, I think had a question.
Okay.
No questions. Does anyone else have a question? We have about 15 minutes left.
I do. This is Mary.
Yeah, hands up, Mary. Go ahead. Somebody else had a question also.
Okay. I mean, this is a little confusing, and there's a lot of information here. Where do you recommend starting?
Well, what we do is we'll have one of our account executives at no cost talk to you, explain this to you, and then they're going to draw for you what we call an organization chart. Okay, and they'll go through every bit of this and show you. And then, in addition to that, if you want to do it now, I can send you some videos that will help you understand it a lot more. That's why you have a corporate strategic advisor. Yes, this is different for small business owners. Most of them have never heard it before. It is complicated. Most attorneys and trust and accountants that I talk to say, well, my client's business is too small for this. And I say, bunk. They need this from the beginning. But because they lack the training and the knowledge, we assign them a corporate strategic advisor. Remember me showing you that earlier? The advisor meets with you regularly. Make sure you understand. We'll teach you over and over and over. It's going to take you 6 to 8 months of regular meetings, and the meetings aren't that expensive to meet with either. We also assign you a personal CFO. I am a CFO right now for almost 80 companies. I meet with them once every 3 months, and we do tax planning. We know where to move the money, when to move the money, who gets how much money. How do we do this, and how do we make arrangements and make sure you stay within the rules? I've got several clients that have been with me for years now, and do it all themselves. I only have to have one meeting a year with them. But initially, it's going to take, there's a learning curve for you guys.
Thank you. Does anyone else have a question? Or two? So you create a LLC. This is my understanding. You create a LLC, and that LLC does the investing into the business.
No.
Okay, then I don't have it correct.
Okay. So your business, your main business will be a C corporation.
Right?
Okay. So I've got some, I don't know whether let me get out of this real quickly and see if I can go back. I don't know whether I've got it or not here. Put it down here.
So it could either be a trust or a LLC, depending
So-
on what it is.
All right. Let me show you this real quickly. Okay. If I can, we'll do the slideshow from the current slide. This is what we suggest for our clients, right? The first thing you're going to do is you have your limited liability company, yes, but that's to own the real estate. Those are all publicly visible companies. You have a family limited liability company that owns your house, right? But you have a C corporation that has a contract with each one of your limited liability companies. And for the family limited liability company, it rents your assets. But what it does with this one here is if your real estate investment LLC, for instance, starts making too much money, it has a contract that the corporation sends an invoice to the LLC. Invoice is paid by that LLC. So let me ask you another question, if anybody can answer this question. What is the tax year for an LLC?
Well, you have to set it up if you want it to be January to December or
It
July.
has to be for an LLC. It can't be anything else,
Okay, okay.
right?
But a
Because it's got to
corporation
match
can.
your calendar year. But a C corporation, S corporations cannot do this, but a C corporation can have a fiscal year,
Mm-hmm.
right? And we usually start on the quarter, April, July, October, right? So we try to keep it away from being that, so that the LLC, when we meet together for CFO meetings, starts making too much money, it's going to have a contract that allows them to pay the corporation for services rendered. Remember, own nothing, control everything, right? If the LLC has money left in the box, let's see if I can go back up here just a little bit. See if I can go back up. I want to show you this real quickly. When you do business, you have money that comes into your box, right? Corporation's box is self-contained. If there's money left in the box, you got money coming in and you pay expenses, money goes out. At the end of the year, whatever money's left in the bottom of the box, and we do taxes on a cash basis, that's the money that the corporation pays taxes on. That's why a corporation's tax rate is higher. But an LLC, the money comes in, you pay the expenses. If there's money left in the bottom of the box, there's a hole in the bottom of the box that's plugged during the calendar year. You pull the plug at the end of the year. The owner catches the money and shows that on their income, as their income. That's self-employment. So the idea is, at the end of the tax year for both of these organizations, make sure there's no money left in the box. And there's only one way to legitimately get money out of the box, and that's by paying an expense.
Mm-hmm.
So if you have a legal contract with anybody on the outside of that organization, remember you're creating everybody, the corporations, LLCs, everybody as separate organizations. You're separate, you're independent of each other. And you have contracts. That's the only way you work together. So that to have that expense, we want you to remain in control, because you are in control of the LLC. You're also in control of the corporation, right? But you are controlling different entities, separate entities. So the corporation sends an invoice to the LLC. The LLC pays that money to the corporation. Corporation doesn't have to declare it as income until the end of its fiscal year, maybe 6 months later. And in the meantime, you're in control of that money. You now get to use that leftover cash to improve your business, to buy more, to improve it, to grow. At the end of the fiscal year for the corporation, That receives an LLC, an invoice from the LLC, it pays the money back. And it's never the same amount because you're always using it. So you get to control the cash. You get to control what's left over. Okay? Does
Mhm.
that make sense?
Yep, Mary, you have another question?
Yes. Can you put IRAs into a trust?
No, yes, you can put them into the trust. Yes, you can.
But can you take distributions?
No, yes, you can.
And
My
what about for
suggestion is,
taxes?
well, here's my suggestion. Just remember this, the type of trust we want you to use, and that's what I was going to go into next. Let's see if I can get past these little things here. The type of trust we wanted to use, well, I guess I have to go. Let's see if I can find back to my trust area. Okay, there we go. Different types of trusts, right? Revocable and irrevocable. Revocable is a living trust. The grantors remain in control, but because it's a living trust, you don't put assets into it, because if you are sued and you're a grantor, you are in control of the asset. Therefore, that asset can be taken out of the trust. But if you use an irrevocable trust, you lose control. The grantors who set it up walk away. They don't control it. They don't do anything with it. You lose control. So there's times to use them and times not to use them.
Hmm.
Okay. So what we suggest, Mary, is you take your IRA or other such assets and put them in your private family LLC. And the private family LLC, let's go down here. Okay.
Mm-hmm.
Private family LLC owns your assets, but it has no legal liability outside your group. Therefore, there is no legal reason to sue that LLC. So you put your home, your cars, your furniture, your IRAs, all of those types of things, and put them into that family LLC, all your investments. The only thing I wouldn't advise in there is putting a 401k. You put your 401k in a corporation. And you guys are going to be volunteer officers of that corporation. You're also going to be the shareholders. You elect yourself as board members, and you elect yourself as officers. And we'll teach you how to do that.
Ted, do you have any questions?
you.
This is right up your alley.
Who are you talking to?
Ted Hollander, he's a CEO.
Right now, I'm still listening.
Okay.
And so what you would do is you would get paid from your family LLC or any of the other LLCs, and you can either take it out as a draw, or you can take it out as a contract payment from the LLC. If you take it out as a draw, it's not tax deductible to the LLC. If you take it, and that's considered self-employment tax, but the idea is take that family LLC with all of the assets in it, make it so that there's no money cash, there's no cash profit, and there, because there's no cash profit, you now depreciate 100% of all of your assets. That turns it into a business asset, which is going to make you money now, because that depreciation puts the LLC at a loss. You then show that loss on your personal tax returns. And that loss can either reduce your W-2 income, or if you pulled out a draw from your LLC, it will reduce your tax obligation for that self-employment income. And you don't have to worry about paying self-employment tax if you have a loss and it overrides that self-employment income, which is what we do in most cases. Because you've turned your personal house and your cars and your furniture and your computers into assets that are business owned assets. And it's no longer an investment in your home. It's not passive income because it is now 100% a business in asset.
Hmm.
So any other questions?
Seems like not. It is a fire hose coming at most people here.
It is. And so what we want to do is to see if we can't limit how wet you get and help you understand it. I'm going to help you drink from a fire hose.
Okay,
We're just not going to tell you about it, Peggy. We're going to show you what to do, how to do it, when to do it. Most wealthy people, they hire attorneys and corporate people, the accountants and estate planners to do this for them. They don't know how it's even done. They're just relying on the people to do it for them. We don't do that. We're going to teach you what we do, why we do it, and how we do it.
okay. Well, that's good. Because you're right, wealth managers hire all those people to do that for them, and everybody needs to have a tax advisor, investment advisor, and quite a few advisors. Actually, whether you're
We have all of
wealthy
those
or
people
you're
on staff
building.
with us. We
Say
have
again?
all of those people on staff with us. You know what I'm saying? Every one of them.
Mm-hmm.
So that's the idea, right? Get
That
a
is the idea.
corporation and an LLC to work together.
I think Mary has another question, and we are
Okay, Mary.
almost at the top of the hour.
Right. The only thing is, I was just wondering how we could get access to the videos that you were talking about to learn a little bit more.
Well,
So,
send me an email, Mary, and I will connect you with them.
Okay, great. Thank you.
We'll be glad to do that. Plus, I've got a couple of handouts that we hand out too that will show you how this is put together.
Okay. Would that be something that you would send us? We could send to everybody that was on the show?
Be glad to do that.
Okay,
You
that would
tell me
be
how to
great.
get it to you.
Okay. I'll send you an email. So what do you call that, by the way?
What do we call what?
Is it like a forms to fill out?
No, you send me the email address and say, we want the handouts and the videos that explain how the system works.
Handouts and videos.
Mhm.
Okay. All righty. And we'll give them your phone number so they can call you.
Okay. As you can tell, there were several things that others that we could have discussed, but the time is short here. I'd love to just go through all of this with you individually again, because it's going to take some time. Daniel here is our expert, right, Daniel?
Learned everything I know from you, Ron.
But if you need to get a hold of anybody, Peggy, talk to Daniel. He'll be glad to talk to any of these people.
Okay. We'll use, I think, I'll make sure I have Daniel's information. I'm sure he put it in here somewhere.
Don does.
Dawn has it.
Yeah.
Yeah, Dawn has it, of
Yep.
course.
Yep.
My wonderful people. Yes. Okay. We will get that, we'll get that request off to you and connect you with Mary.
So in ending, just real quickly, Ted, give me your thoughts. Peggy says that you're the expert in a lot of this type of stuff. Just give me your thoughts real quick.
Well, I'm not sure I should claim an expert in this particular area because, let's say my skill set is to, let's say, lead accounting teams for small companies so that the owner understands his business.
Cool.
You've got some, let's say, some interesting nuances relative that definitely should be, let's say, considered in the, let's say, family offices. And there's certainly an issue as to, let's say, how to, let's say, how to make, let's say, how to make revenues that offset the costs of setting up all this infrastructure.
Well, and if we do our job right, and I can't guarantee it because it's illegal and unethical for me to do so, but the majority of our clients, when they go through to do this, and it's not that expensive. Like I told you, we do things for the small business owner like the wealthy do, but we don't charge what the wealthy have to pay for those benefits. But if we do our job right, you should get the majority, if not all of that investment back the first year.
Right. Businesses get to write expenses off.
Well, not only that, you can actually get that in your pocket. You get to write that off and put the money back in your pocket.
That's always nice. I like my pockets bulging. So thank you very much, Ron, for coming on and explaining this. It is a little, like I said, fire hose. It might be good to split it up and deliver it as maybe two different, doing the trust separately from some of the other things because of the amount of time that we have. And there's a lot of information, and confuse people pretty much are a no, and we don't want them to be confused. So we'll do everything we can to.
Well,
some
and if
appointments
you're
set up.
confused, Peggy, I'd love to talk to them. I'd love to help them not be confused. Daniel can do the same thing.
Okay,
And so can Jeanette or Patricia, and so can Debbie.
okay, great.
Debbie's out of Oregon, Patricia's out of Minnesota, Daniel's out of Iowa. We have professionals working with us all over the United States.
That's fantastic. Super fantastic. So thank you very much for being here today. We do hope you'll come back again.
Okay.
Thank you very much.
Hey, we're so happy you're all here, truly.